August 1998, a man in Moscow walked into his bank to withdraw his life savings and was told politely that the bank simply did not have his money. Not come back tomorrow, not there's a delay. The money was gone, converted into government paper that had just become worthless. Within 72 hours, the ruble lost two-thirds of its value, the country's largest bank stopped functioning, and a nuclear superpower defaulted on its own debt in its own currency printed by its own central bank. That last detail is the part that should stop you cold. Russia did not run out of foreign money. It ran out of trust in money it created itself. If a government can default on debt denominated in a currency it literally prints, what does that tell you about what money actually is? This is the story of the 1998 Russian financial crisis, sometimes just called the ruble crisis, and it matters far beyond Russia. It is the clearest real-world lesson in how confidence, not cash, is the actual engine of modern finance. Whether you keep your savings in a bank, invest in bonds, or just wonder why economists panic about government debt, this crisis shows you the mechanism up close, in fast motion, with real consequences for real people. Rewind to the early 1990s. The Soviet Union has just collapsed, and Russia is attempting the fastest transition from a planned economy to a market economy that history has ever seen. Prices are freed overnight. State industries are privatized, often into the hands of a small group of politically connected businessmen who would later be called the oligarchs. Tax collection is chaotic. The government needs money constantly, for salaries, pensions, and a war in Chechnya, but it cannot easily raise taxes, and it does not want to print rubles wildly, having already lived through the hyperinflation of the early 90s. So it turns to a tool that looks modern and disciplined: short-term government bonds, called GKOs. A GKO, short for Государственное краткосрочное обязательство, or government short-term obligation, works like a slightly fancier IOU. The government sells a bond today for less than its face value and promises to pay the full face value in a few months. The difference is the interest. Investors, both Russian banks and foreign hedge funds, loved GKOs because the yields were enormous, at times over 100% annualized. That number alone should have been a warning. When a supposedly safe government bond pays interest rates that high, the market is not rewarding safety, it is pricing in fear. It is worth pausing on why the government resisted simply printing more rubles to cover the gap. Printing money directly tends to show up almost immediately as inflation, prices rising because there is suddenly more currency chasing the same goods, and Russia had already lived through a punishing bout of that in the early 1990s, wiping out savings once before. Borrowing through GKOs let policymakers delay that reckoning, at the cost of making the eventual reckoning much larger. Here is the mechanics of the trap Russia built for itself, step by step. First, the government did not have enough tax revenue to cover its spending, so it issued new GKOs to raise cash. Second, when those bonds matured a few months later, it did not have the money to pay them off either, so it issued even more new GKOs just to repay the old ones. This is called rolling over debt, essentially borrowing from tomorrow to pay yesterday. Third, because investors sensed increasing risk, they demanded higher and higher interest rates to keep lending, which made the whole structure more expensive every single cycle. Economists have compared this to a pyramid scheme, and the comparison is fair. New money coming in was used to pay off people who invested earlier, with no underlying productive activity generating the returns. It works beautifully, right up until new buyers stop showing up. Think of GKOs like a chain letter dressed up in a suit. Everyone in the chain is fine as long as fresh people keep joining at the bottom, and the moment the newcomers stop showing up, everyone above them is stuck holding paper nobody wants. At the same time, the Central Bank of Russia was defending a fixed exchange rate, essentially promising that the ruble would trade within a narrow band against the US dollar. A fixed exchange rate can bring stability, letting businesses plan without worrying about currency swings, but defending it costs real foreign currency reserves. Every time investors wanted to convert rubles into dollars and leave, the central bank had to sell dollars from its reserves to keep the exchange rate stable. Reserves are simply the country's stockpile of foreign currency and gold. its emergency fund. Three turning points pushed the system over the edge. The first was the Asian financial crisis of 1997, which made global investors deeply nervous about any emerging market, Russia included, and capital started leaving. The second was the collapse in oil prices through 1998, which gutted Russia's main source of hard currency earnings, since oil and gas exports were the backbone of its foreign income. The third, and most decisive, was a simple loss of faith. As GKO yields spiraled upward and reserves drained, investors concluded that Russia could not keep this going, and the moment enough people believe a system will fail, they rush to exit before everyone else does, which is exactly what guarantees the failure. In July 1998, the International Monetary Fund and other lenders approved a rescue package worth about $22.6 billion, hoping a show of confidence would calm markets. It bought a few weeks. It did not fix the underlying math. On August 17, 1998, Prime Minister Sergei Kiryenko's government and the central bank announced three things simultaneously. They devalued the ruble, widening the trading band so the currency could fall further. They declared they would restructure the GKOs, meaning investors would not be repaid on the original terms, essentially a default on domestic debt. And they imposed a 90-day moratorium, a temporary freeze, on private banks repaying their foreign debts. Within weeks, the ruble, which had traded around 6 to the dollar, was trading above 20. Major banks like Incombank and SBS Agro, which had leveraged themselves heavily in GKOs and foreign currency bets, collapsed outright. The human cost was immediate and brutal. Ordinary Russians who had rubles in savings accounts watched their purchasing power evaporate in days. Pensioners who were already owed back pay saw it become worth a fraction of what it once was. Small businesses that imported goods, priced in dollars, went bankrupt as their costs tripled overnight. Meanwhile, some politically connected banks and insiders who had advanced knowledge or influence over the timing of the devaluation managed to move their own assets into dollars just before the collapse, walking away far better positioned than the citizens who trusted the system. The crisis also jumped borders. Long-term capital management, a massive American hedge fund run by Nobel laureates, had heavy exposure to Russian and related bonds, and its near collapse forced the Federal Reserve to organize a private bailout just weeks later to prevent wider damage to global markets. Brazil, facing similar investor panic, was forced into its own currency devaluation the following January. And yet, oddly, Russia recovered faster than almost anyone expected. The weaker ruble made imports expensive, but made Russian exports, especially oil, dramatically cheaper for foreign buyers, giving domestic industry a real boost. Rising oil prices from 1999 onward filled government coffers again. Political change followed too, with Yevgeny Primakov taking over the government and Vladimir Putin rising to prime minister in 1999, riding the wave of recovery. The system that broke was rebuilt with harder lessons baked in. So what should you actually take from this? First, watch for absurdly high yields. If any investment, government or private, is offering returns that sound too good relative to its risk, the market is usually pricing in a danger you are not seeing yet. Second, remember that debt rollover is fragile. Any borrower, a country, a company, even a person who depends on constantly refinancing old debt with new debt is one bad week of investor sentiment away from disaster. Third, fixed systems, whether a currency peg or a promise that never changes, look stable until the moment they cost more to defend than they are worth, and then they break fast, not gradually. Fourth, in any crisis, information and access matter enormously. The people closest to power often protect themselves first, which is worth remembering whenever a system suddenly changes its rules overnight. Here is the reframe. The 1998 Russian default was not really about rubles or bonds. It was proof that money itself is a shared belief. And the instant enough people stop believing at the same time, that belief can collapse faster than any government can respond. If this kind of story clicked something into place for you, subscribe, hit like, and drop a comment with the next economic mystery you want unpacked. Whether it is the 2008 crash, hyperinflation in Zimbabwe, or something happening in the headlines right now.